Now, very good afternoon, friends. We are going for a new interesting division called a capital budgeting. Capital budgeting, or otherwise called investment decision. My dear friends, you cannot find any FM question paper without any capital budgeting question. So I will give you half an hour consolidated discussion of all the tests in capital budgeting. If this discussion is over, you can solve any type of question in capital budgeting. For that, you have to practice question. You have to practice the question. First one it is, you have to check whether the cash flow is given or not. First, you have to check cash flow is given or not. If cash flow is not given, any capital budgeting methods you do, first you have to check cash flow is given or not. If cash flow is not given, you have to find the cash flow. That is the first step. That is what statement showing computation of CFAT. Statement showing computation of what? CFAT. This depends. Sometimes they'll give PAT, sometimes they'll give PBT, sometimes they'll give sales data itself. So depends upon the data you have to work it. So this is a sales. From the sales you can be able to discuss less your whatever your expenses, your cash expenses or your expenses. You will get your data EBITD, or otherwise less. This can be called as EBITD if all are cash expenses. Now you will get what? Then you have to reduce the depreciation. If you reduce the depreciation, this is what is called. Now what you got this EBIT, this is also called before tax cash flow. Cash flow you have to find out after tax. Cash flow you have to find out after tax. So this is called as before tax cash flow. That is sales less all the cash expenses. You will get what? Before tax cash flow. Not PBT. PBT is different. Before tax cash flow is different. Then if you reduce in before tax cash flow, you are not considered the depreciation effect. Depreciation will get a tax effect. That is, you have to reduce what? Less depreciation. You will get EBIT, or otherwise called PBT. There is no interest. You want to reduce the tax. You will get your PAT. Then you have to add a depreciation. This is called after tax cash flow, or otherwise called a Are you clear? We have also discussed there is a shortcut method. If already before tax cash flow is there, how to do? You can get one method called your EBITD into 1 minus tax plus depreciation into tax. This is a shortcut method. So depends upon the question you have to understand. Some question PAT you have to start. Some question PBT you have to start. Some question EBITD you have to start. Some question you have to start from the sales. Some question you have to start from the unit itself. Units into selling price accordingly. So this is the first point you have to check whether CFAT is given or not. If CFAT is given, then you have to check which method we have to do. There are different methods are available for capital budgeting decision. There are different methods are available for capital budgeting decision. Then you have to check which method you have to do. Shall I proceed, friends? The first method we have is called payback period. Payback period is the period in which you are able to recover our initial investment. Lower the payback, better the option. You can do two ways. If every year same cash flow, year 1, 2, 3, 4, 5. If your cash flow is 50,000 every year, your initial investment, let's say 2 lakh. If every year same cash flow, there is a shortcut 2 lakh divided by 50,000 4 years. Or else we have a different method called CCF. You have to keep on adding it. This is how. So here your 2 lakh is getting what? 40. How interesting. Everything in the regular class I am discussing, the approach in calculating is different. I am discussing in detail that any question you can be able to solve. You are getting my point? Suppose if different amount, this 60,000, this is 20,000. In this case, how you do? It is between 4 and 50 year. It is between 4 and 50 year. How you will do here? You have to do You have to do a small formula. I hope all of you can able to recall. It is after the fourth year. So fourth year plus. It is what year you will be able to get it. You want to get 2 lakh. So far you got 1 lakh 80. Now you got 50. So what is the answer? 4.44 years. This is how you have to find out. This method we call it as what? Payback period. This method we call it as what? But this having some limitation. See the point is what? If sixth year, if you are getting 1 lakh, it doesn't consider. This cash flow after the payback doesn't consider. Then another one limitation, it doesn't consider the time value. In order to overcome that, we have a next one method called discounted payback. We have a discounted payback. What is this discounted payback, my dear friends? Same cash flow only. What we will do now, we will take a one additional column. That is, see, you're getting 50,000 today, 50,000 after 4 years. Both are same value or different value? Different value. So you have to consider time value of money. For that, you will take what? Discount rate. You will go for what? Discounted cash flow. Let us assume 10%. Question, they will be given the cash flow. See here 0 I have taken from year 1. What is the about 909 826? Okay, let's say our initial investment is 1 lakh 50. What is about? So payback, when you are recovering this amount, first step discounted cash flow. This discount rate will be given in the question. You don't want to make it. Now, whether it is a discounted payback or payback, the step is same. You have to go for what? Cumulative. You have to go for what? Cumulative. So discounted cumulative cash flow. Hope you are able to recall. So you just gone through. See 1 lakh 50 when it is covering between 4th and 50th year. So your discounted payback period will be 4 plus. You want to get to 1 lakh 50. You are getting 1 lakh 40 for 180 divided by particular you are getting what? 3105. How interesting. 4 point lower the payback. See this payback then the problem is what? This year though you won't consider it. You are ending your calculation with this recovery. This is overcome under the next interesting method, which we call it as NPV. Which we call it as what? NPV. NPV, there is a formula also. Present value of cash inflow minus present value of cash outflow. Present value of cash inflow minus present value of cash outflow. So how can you do this here? Your NPV will be your present value of cash inflow means you have to take the sum total of all. What is the sum total of all these amount? 2 lakh 31 530 minus your outflow is what? 1 lakh 50 81,000. Correct. But this NPV doesn't consider the outflow effect. For that, we have another method which is called a profitability. There is a formula for that also. Profitability index is equal to present value of. Are you able to recall? Yes or no? Now another one point is what? See here, here you are getting. Yet if you go for your initial investment, if I am reducing the initial investment less outflow, which is 1 lakh 50. I am getting a NPV of what? Positive. You want to know at what rate your inflow is equal to outflow. That is what project return. That project return we called by a name called IRR. IRR stands for internal rate of return. It is the rate of return at which this how you can do it. There are two ways. For IRR, you should get two discount rate. You should get what? Two discount rate. In this case, already we have 10. So we can try for what? 20%. Example. But you can have another one proper method. We have discussed one proper method called IRR range. What is IRR range, my dear friends? We can do randomly 20, but we can do another because I'm consolidating everything. So one discussion you'll be able to recall everything. This will be very, very useful for those who already revised the capital budgeting. If you opened your capital budgeting book 2 months before, 3 months before, very difficult because I'm going to extreme level discussion also. So IRR range, how you will do? Initial investment divided by average cash flow. This is the formula. So your initial investment is what? 1,50,000 divided by average cash flow. Average cash flow, you have to add it all the 6 years divided by 6, 55,000. So your IRR range is 1,50,000 divided by 55,000. So what you will get? 1,55,000. So if you do this, sir, when you have to do this, if the question they given range clue, if they given 2, 3, 4 discount rate, then you have to do. Otherwise, you can take randomly what? 20%. Otherwise, you can take what? Now, how you will decide this? For this, you should get lot of discount rate, 18%, 22%, 25%. Are you ready, friends? What you have to do now? I am taking this. Now, how many years cash flow in this question? How many years cash flow? 6 years. So you have to take the annuity factor for 6 years. You have to take annuity factor for what? 6 years. How you will get? This is not exam, it will be given. We have to do 1 divided by 1.15 equal to 68. Can anyone tell me what is the answer? 3.78. Next year. Sorry? 3.49. 3.32. Next year. 32 is not. What is that? Next. Come on. How to do 1 divided by 1.22 is equal to 6 times. GT option. What is next in? 2 point. No, you have to change it. 3.16. 25 what you will get? 1 divided by, yes. 2.95. What is for 30? 2.64. Now just listen. This role will be given in the question. Now just listen. You want to get 2.81. This 2.81 you want to analyze in which range? It is coming between 25 and 30. So you want to find out what is the NPV at 25, what is the NPV at 30. Then you have to apply the formula. See, if I do 25 and 30, it again getting confused, time lengthy. So what I will do, already we have 10. I will take here what? Discount rate at 30 for the time being. So we recalled the method of what? IRR range. But now for solving this IRR, I am taking 30 only. I am not going for 25. I'll take 10 already with 30. Are you ready? So can you please tell me the discount rate for 30? 1 divided by 1.13. What will get it? 7, 769 591 455 350 269. Are you clear? Now you have to go for discounted cash flow. This is your cash flow. This is your discount rate. Since I am using Excel, just scroll down. See, if you do this IRR range, definitely you will get 1 plus 1 negative. But more accurate answer will take close number you take. If you take close number 25 and 30, if you take more accurate answer will come. Small slightly will change. So we discussed the IRR range and how to approach. If you want close answer, you have to go for 25. That again time consuming. We have already 10% one NPV. We have 30% one NPV. We know for getting IRR, you should get one positive or one negative, or else two NPV data. Even two positive also you can do it. So what is the IRR formula? Can you recall, friends? IRR is equal to, you see the logic is what? It is after 10% but before 30, because at IRR your NPV is what? 0. 10% you have positive, but 30% it is what? Negative. So it is between that. How you will do? IRR is equal to 10% plus. First you have to take what? Difference in NP. What is the first point? NPV at positive 81,530 divided by difference. Minus will become plus. So what you will get? 96 into what you will get? Difference 20. This is why I told if you take close to number, more accuracy will come. But here is for understanding. That is why I will do this. So what you will get, my dear friends? 26.83. This is how the at the 26.93 you will get NPV is what? 0. So we discussed what, my dear friends? Which are all the methods we have discussed now? We discussed payback, discounted payback, NPV, profitability index, IRR. See, next, these all the methods are on the basis of cash flow. All these methods are on the basis of what? Cash flow based. There are some methods in that time value based method only. These all are time value based. If you classify different cash flow based, time value based, what is time value? Take the discount rate. Now we have another non-cash flow based. In non-cash flow based, we have an interesting method called ARR. What is that? ARR. Very easy. ARR stands for average PAT by average investment into 100. Average PAT by average investment into 100. How you will do? In this example, this is cash flow only. You want to get the PAT. Let us assume PAT and cash flow both are same. Generally, we know how to get. From PAT and depreciation, you get what? Cash flow. So if you have cash flow less depreciation, you will get what? PAT. But let's assume this cash and PAT both are same. So your average PAT is 55,000. What is the formula, my dear friends? Average PAT. That we have to find out all the PAT. Here I have told you 55,000. Average investment means half of your investment money, because opening plus closing you will get what? 75,000. So your ARR will be 55,000 divided by 75 into 100. This is how to find. Are you clear? So this is a road you have to be able to understand. Hope you are able to understand. NPV, higher the NPV, better the option. Profitability index, higher the profitability index, better the option. IRR, higher the IRR, better the option. ARR also, higher the ARR, better the option. Clear or not? Now let us you, all of you able to clear all these methods. So we were completed all the different main method of, in that in IRR also we discussed one more point called MIRR. MIRR is what? Modified internal rate of return, which is theory purpose we discussed. This is not that much relevant for exam perspective. Now coming into next area, we will able to proceed another very interesting point called we have two project A and B. Same concept only. So formula based we did, now we go for concept based. NPV also we discussed, we will go for further concept. What is the further concept? See, the life of A is what? 3 years. Life of B is what? 2 years. The NPV you found out. Here 10,200. Here it is 9,800. Let's say cost of capital is 10%. Tell me, A is best or B is best? A is best or B is best? If you're able to recall your class discussion, you will reply. See, we can't tell here A is best or B best, because the life of the projects are different. If life of the projects are different, you have to do another method called what? EAV. You have to do another method called EAV. What is EAV? Equalized annual value. You have to find out for that annuity factor. You have to find out for that what? Annuity factor. For 10%, 3 years, you have to find out. So I am repeating again, those friends who not at all open the capital budgeting chapter, for them it will be a rocket. That is why please pause the video, watch or revise all the capital budgeting. Then only you start watching this revision session. So coming to my dear friends, what is the annuity factor, my dear friends? Because those who revise, they will be able to get everything 100% revision. Entire topic in 20 minutes or half an hour, we are covering. So what is the annuity factor, friends? 2.48. What is for 2 years? 1.733. Now you have to do EAV. How to do EAV, friends? NPV. Now, higher the EAV, better option. Higher the EAV, better option. Which one is best? Now, this one, this two. So, best one it is what? B. Best one it is what? B. Are you clear? So, this is you have NPV. Now, next level discussion. Are you clear, friends? Shall I proceed? Are you understood? Now, with your permission, we are proceeding into next level discussion. In next level, what we are going to discuss, friends? Next level, we are going to discuss outflow only event. Machine and all, when you are selecting, there will be only outflow. So, machine A, machine B. Present value of outflow. Outflow means what? Initial investment and other value. Outflow is 14,300, 22,100. Useful life also given. Useful life 3 years. And here we'll go for what? 5 years. Tell my dear friends, which is best? When you are discussing outflow, lower the outflow, better the option. When you're discussing, lower the outflow, better the option. When you're discussing, you have to go for what? Lower the outflow, better the option. So for that, here if you go, one is 3 years, one is 5 years, you can't compare again. If it is both are 5 years, best is A. But here not same years. So what you will do? You have to go ESE, very good. Equalize the annual cost. Again, you have to go for what? Annuity factor, same 10%. Can you just tell me what is the rate? 2.2, 3 years 2.48. Here 3.78. Now you have to do EAC. What is EAC? EAC is equalized annual cost. So 14,300 by 2.4. Lower the outflow, better option. So which is best? A is best. Are you clear? So we will discuss the different concepts. Capital budgeting techniques, EAV, ESE, different useful life. Correct or not? Now, shall I proceed? All of you ready? Thank you. Now, this is your question on what? NPV. Let assume in this example, see, in this example, let assume every year amount is 50,000. Every year amount is what? 50,000. If every year amount is 50,000, we call it as every year same amount. You can go for a shortcut method. You don't want to go this lengthy method. We call annuity factor mode. We can go for annuity method. This here you get NPV is what? This is the way you will get the NPV. But this answer you can get in one line. How can you get this in one line? You can go for year 0, year 1 to how many years? You have to go for year 1 to 6 year. What is the cash flow in year 0? Year 0, 1,50,000. 1 to 6 years is what? 50. Here discount rate at 10%. Here 1 to 6 years, don't want to take all. You have to take the sum total 4.353. You have to go for discounted cash flow. See the my dear friends, you will able to get it the same amount. See, this lengthy answer. That means wherever come same cash flow, it can be any year, you can use this concept. This is what is called annuity factor. Already we told that this can be used wherever. Are you clear? Now, exam, there may come reverse calculation question. Reverse calculation means they will give you the annual cash flow, they will give you the NPV, they will ask you what is the outflow, what is the inflow, what is the IRR. That is also relevant. Then we discuss essay model question. Then finally in your topic we will have question based on this statement. Essay model question will come this statement. They will give you the data from this statement. If any specific method is asking, you have to do specific method. If they are not asking any method, then the best method you have to follow for decision is NPV. The best method you have to follow for decision is called what? NPV. Now going final discussion. See, apart from this, we have advanced problem which is similar to your additional final level or professional level, which is comes under replacement. This is called what? Replacement. What is mean by replacement? You are already using a machine, then you are going to change with a new machine. You have already written the notebook, very simple concept only. You want to identify old machine, what is the incremental cash outflow, what is the incremental cash inflow. If incremental cash outflow is more, incremental cash outflow is more, then what you will do? You will do, you outflow is more for the machine, you will do the replacement. If inflow is more, you will do the replacement. We did question also on that replacement. So replacement also very interesting area. How to do incremental cash inflow or cash outflow? Very interesting. If you want to do incremental outflow, I am telling the format again. Already you have written in your notebook. First one, what is the incremental outflow? What is the purchase price of new machine? What is the purchase price of new machine? You have to less sale value of old machine. Sale value of what? Old machine. In sale value of old machine, what you have to do? Net sales value. What is net sales value? The sales value of old machine is 80,000. But for this 80,000, you are incurring a cost of 10,000. So your net amount you have to consider only what? 70,000. Let's say in 70,000, the book value is only 50. If book value is only 50, then you are having, can anyone tell? Very good. You are having a short-term capital gain. That is book. You are selling at 70, 50,000. You are having a book value. You are getting a short-term capital gain of what? 20. Tax rate is 50%. So additional outflow of what? 10,000. So again you have to reduce 10,000. So the net amount will be what? 60. So if your new purchase machine is 2 lakh, though the book they given 80,000, but you have to take only what? 60,000. Your incremental cash outflow is what? 1 lakh. How interesting. There are some shortcut. Short-term capital gain, you can give a note. Short-term capital gain is not considered. If specifically asked, then only you can able to take it. If this is 50%, if it is 40%, answer will change. Here it is 8,000 only. So accordingly, this will change. Here will come what? 62,000. Are you clear? So all the concept, what is incremental cash inflow? What is the inflow from old machine? What is the inflow from new machine? That is what? Incremental cash inflow. If inflow nothing is given, expense you can compare. Old machine, your expense is 1 lakh. New machine is an advanced machine. You will incur only 80,000. So your savings is what? 20,000. The savings is equivalent to what? Inflow. Savings is equivalent to what? That is all. Your which one also over? Replacement also over. My dear friends, if you refer all the question we did in the class, it will be come under this area only. You can just revise it, all the question what you have written. We taken around 8 to 7 classes, close to 40-55 question we have did it. All the question we have just revised. Very fast you can revise. Once you revise, we'll take a standard 3-4 question, consolidate the question, then we'll approach it. Are you clear, friends? Come on. So now what we are doing is we are taking a consolidate question in every aspects. We will discuss different aspects. That is capital budgeting method, NPV, IRR, profitability index. One question. Then reverse calculation, one question. Then we will do additional question on what? A comprehensive question. Comprehensive question means all the parameter considering. Then all the different models we will discuss very fast. Are you ready? For time saving purpose, what we will do now? We'll learn our class workbook itself, because our class workbook we have taken a lot of questions from CA Inter already. So majority question I am taking from CA Inter or previous year only. For this chapter, because of the important class workbook itself, we incorporate a lot of questions. So we are doing it directly itself. Are you ready? So what you can do now, I will give you two options for you, because we want to make little more discussion, because you know very well each calculating technique problem will take more time. Each calculating technique will take more time. So what is our strategy is what? You already have notebook, you have the answer also. You can parallelly check with me so we can save a lot of time. If you want to practice, you can practice. But since I am using Excel, I will go little fast. So it is your wish only, correct? Because this chapter, if I do one consultant question, that is will take 1 hour or because exam only 2 or 3 only, but I will take a essay model question. That is it will take more time. So we'll start with question number 32. Question number 32, they were asking payback period, discounted payback, NPV, profitability index. But we will add few more items. We will add, because we are doing consolidated, we'll add few more items called the ARR and also IRR. That means we'll discuss all the methods. That is why it will become lengthy. So in the class already we did 4, but anyway everything I will do on the board. Are you ready, friends? This having a different standard point are there. Shall I start, friends? So question number 32. Shall I? See, in question number 32, they are given the cost of the machine is what? 50 lakh. Annual income after depreciation but before tax. CFAT given or not given? My dear friends, please believe, very rarely for your exam CFAT will be given. Don't think that your institute is very easy to give you directly CFAT. So very rarely only they will give CFAT. They may give CBAT, EBAT, different perspective. Here they given before, after depreciation but before tax, which is called PBT. Which is called what? PBT. What all they are asking? Payback, discounted payback, NPV, profitability index, ARR, and also IRR. In the class we did only 4, but one question we want to learn everything. So we'll do ARR and IRR also. Are you ready, friends? So first we have to prepare what? CFAT. First we have to prepare what? CFAT. So we have to go for statement of CFAT. So one question you will able to, recall all the point, my dear friends. So year, how many years? 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Now what is the next point? Annual income after depreciation but before tax. It is PBT. See, in this question PBT, I have taken willfully one item. Sometimes they'll give EBITD, sometimes they'll give PAT. Depends, it will change. So what is the item? 3,50,000. Every year different amount. If every year same amount, you have to prepare only. If every year same amount, you have to prepare only one item. You can just put 1 to 5. But here different amount. I taken willfully this question because you will be able to get that exposure also. 3,10,000, 1,75,000, 1,10,000. Are you clear, friends? Yes. Now we will go for the numbers. First we will go for PAT. Tax we know. So directly I will return as PAT. What is a PAT? We know shortcut. If tax is 30%, PAT will be what? 70%. PAT will be what? 70%. So what will come? Now you have to add depreciation. Depreciation they are not given. We have to find out. 15 lakh, no scrap value. Useful life is what? 5 years. So 15 lakh minus, so you will get 3 lakh. So depreciation SLM only, nothing mentioned. So every year same amount. You will get what? CFAT. So you will get the answer. How interesting, my friends. They are not asking CFAT, but holding the answers you require what? CFAT. So what role they are asking? First they are asking payback. I will do here itself. So payback, you have to do what? Cumulative cash flow. So we'll start, friends. See, what is your investment, friends? Your investment is what? 1,50,000, which is covering in 50 lakh. Third year itself, you can stop it. So you can go for your payback period. I hope you are all clear. You are able to understand also. So payback period will be what? 2 year plus you won't get 15 lakh minus 11 lakh 5,400 divided by what will be the answer, friends? 2.7. Now next they were asking discounted payback that you can't do here shortcut. You want to do statement. Statement of NPV for everything it's coming. Statement of discounted payback, NPV, profit, everything you can take. So how we will start? Year 0, 1, 2, 3. There is no 6 here. So we have to take cash flow. 15 lakhs. We have to start with what? We have to take each year amount. This. You are very good persons. Hope all of you are able to recall. Hope all of you are able to recall. Are you clear? What is next? 12%. Are they given the discount rate? If they given, we have to take it. 0.797. 5. You can go for discounted cash flow. Now you can go for discounted cumulative cash flow. Correct? For me, since I am using Excel, just scroll down. So how you will get discounted payback? Can you please tell me what is the answer? 3 plus 15 lakh minus 13 lakh 1,428 divided by 3.73, 3.738. Yes. Are you clear, friends? This is how you have to approach. So you go to now what? Payback. Now we can go for NPV, present value of cash inflow, which is 70,83,897 minus 15 lakh. What will be the answer? 2,83,000. Are you able to recall? Now profitability index 17,83,897 divided by 15 lakh. What you will get? 1 point. Are you clear? Going next, we have to go ARR. For that, average PAT by average investment into 100. Average PAT, here they have PAT. You have to take all the PAT. This is the PAT. How many years PAT is this? Are you clear? 5 years. So you have to divide by 5. Average investment is SLM only. So you have 7,50,000. Very good, friends. So this amount divided by 7,50,000 into 100. This is the answer. See, this we are not done in our regular class. This I am given a idea. After this, they are asking what? IR. Now already we did one IRR question, so no problem. We'll go for another consolidated question. Are you clear? IRR just now only we discussed one detailed question. I discussed one detailed question. That is not an example. It's a Detailed question with IRR range we discussed it, NPV positive everything, same thing only. Now we will go for reverse, which is 2 3 times previous year question for both CMA, CS, CA, everywhere. Multiple times this question came. Which is the question, my dear friends? Let me tell you. This is, if I'm not wrong, 48. What is the page number? Multiple time previous year question. You can put a star mark also. Very good question. Multiple time previous year. Reverse question. See, if they ask direct question, what they did now is what? Direct question. If they ask direct question, they may not give you CFNT. If they give direct question, they may not give you what? CFNT. If otherwise, they will ask you what? Indirect question. So indirect question, they given annual cost saving 40,000. Savings is otherwise called what? Inflow. Useful life 4 years, IRR 15%, profitability index 1.064. Everything is asking, salvage value is nil. Tell my dear friends, let's see how many of you are able to recall how to start. You have to approach with IRR. At IRR, present value of cash inflow is equal to present value of cash outflow. So a very good question. You are discussing 48. At IRR, present value of cash inflow is equal to present value of cash outflow. So actually, they were asking us first one thing. They were asking us first one thing. What they're asking first? They were asking first the cost of the project. Actually, I am not doing cost of the project. I am doing now inflow only. But at IRR, inflow is equal to outflow. That is why you will get cost of the projects. So what is the cost of the project? You know, every year same cash flow. Cash flow into annuity factor only inflow. So your cash flow is 40,000. IRR is 15. 15 is what is annuity factor. So you have to do 40,000 into, you will get what? 2.855. 1,14,200. Are you clear? Next, what I have to tell you that all of you able to understand. Next, the clue is you have profitability index. What is the formula for profitability index? Present value of cash inflow. This is very, very important. See, this inflow with the IRR rate for PI or NPV, everything you have to use what? Cost of capital that you don't know. That you don't know. Here, this inflow is different. This inflow is with what? IRR rate. Here only you take what? Your cost of capital. But you know one thing, present value of cash outflow. Present value of cash outflow only your cost of the project. That we know already, 1,14,200. So now you have to go reverse way. 1.064 is equal to your X divided by this inflow, 1,14,200. So present value of cash inflow with the cost of capital is what? 1,14,200 into 2.064. What you will get? 1,21,509. Are you clear? Now NPV is what? Inflow minus outflow. You got inflow, you got outflow. So the answer is what? 21,509 minus. All of you clear, friends? Pakka. Now mainly last part, present value of cash inflow with the cost of capital. Now only we discussed what is your annual cash flow into annuity. In the revision session we have told every year same cash flow we will multiply with what? Annuity factor. Annuity factor of what? If you want to get what is your cost of capital only we have to take. Now reverse way. Your annual cash inflow is what? 1,21,509. Your annual cash flow we don't know. Annual cash flow we don't know. Into annuity factor. So if you go for your annuity factor, annual cash flow we know, which is given in the question, 40,000. So your amount will be 1,21,509 divided by 40. A very standard question, but hope all of you able to recall. What is the answer, friends? 0.0378. You have to check this corresponding rate. This annuity factor is coming for what? Not this, not this. Yes, here it is. That means 12% is your cost of capital. How interesting. Finally, they are asking what? Payback. Now only we discuss the revision. Every year, same cash flow. There is a shortcut for payback. That is initial investment by annual cash flow. Your initial investment is 1,40,200. Annual cash flow is 40,000. What you'll get? 2.55. Yes. The question is over. Multiple times previous year question. Any doubt? Please ask. Or else please review very well. If you are 100% comfort, and move to the next question. Now, my dear friends, we'll go for another question. Now we'll go for another question. When there is only outflow, how to proceed? When there is outflow, how to proceed? 26. We'll go for another question. This is a previous year question also. This is machine. You have majority of outflow and years also different. We discussed years also different. So with your permission, I will read the question. A company has to replace one of its machine which has become unserviceable. Two options are available. A more expensive machine with EM which are having life of what? 12 years. Another machine having a life of what? 6 years. It has replaced the delivery of 6 months. They given the data. Purchase price, scrap value. Scrap value when it will come? End of the year. Overall cost they tell 8th year. Annual repair when it will come? Annual repair. Annual repair will come every year. They given the discount rate, everything here. We have to ask which one you have to machine you have to purchase. So this is the case which I have discussed the third method, that is statement of net outflow. You have to go for what? Statement of net outflow. So with your permission, we'll start, friends. We have two machine, EM machine and also LM machine. We have two machine, EM machine and LM machine. So how we will start, friends? I will do very shortcut method. You might have been written a detailed method. First, purchase cost. What is the time value of purchase cost now, today? So you have to multiply with 1. So 20 lakh into 1, 20 lakh only. Here you will have 40 lakh into 1, 40 lakh only. Next, present value of annual repairs. Present value of what? Annual repairs. What is your annual repair amount? 2 lakh. See, EM machine, how many years? LM machine, how many years? 6 years. Hope you have read the question period. Hope. EM is what? 12 years. LM is for what? 6 years. So you have to repair. So as you said very clear, annual repairs will come every year. So if it is a 12 year, it will come what? Entire 12 year. Are you able to follow? Yes or no, friends? So 12 year, if it comes, you have to take 12 year annuity value, which is given in the question 5.66. So 2 lakh into 5.66. Now coming here it is 6 years, 3.889. Here the amount is 2 lakh 80 into 3.889. Are you clear? Next we have overall cost. Present value of overall cost. When it is overall cost is increasing, is it every year? Only 8 year. So the amount is what? Overall cost is 4 lakh. The amount is only 8th year. 8th year discount. So everything discounted is given in the question. 0.3506. So 4 lakh into 0.3506. What about here, friends? 2 lakh into which year? 4th year. 0.5921. Very good, sir. So 2 lakh into 0.5921. Are you clear, friends? Now you got present value of overall cost also. Now there is a one item scrap. All these are outflow, but scrap is what? Inflow. So you have to do what? Less present value of scrap, you have to minus. If all are outflow, one inflow will reduce. All are inflow, one outflow will reduce it. Here it is ulta. So what is the present value of scrap? You get scrap value 3 lakh. It is 12th year. So 3 lakh into 12th year rate is what? 0.2076. The next is what? Sorry? 3 lakh into 0.4545. Now you can able to get, this is what is called present value of net outflow. You have to take this plus minus. This you have to take what? Plus minus. Now can you take a decision with this? 1 year for 12 years we discuss the concept. So outflow now, lower the outflow, better the option. But the point is what? You have to go for your EAC. This is the amount. If 12 year now, 12 year annuity factor 5.66. Here it is 6 year now, 3.899. Lower the outflow, better the option. So you have to go for what? Are you clear? So we discussed a direct question, reverse question, cost based question. Hope you are clear. Please understand, please ask if any doubt. So we're discussing all the different models for you to understand the concept very well. Now, my dear friends, if I go for 37, we have already done this payback, ARR, everything. We'll do one more concept in this question. Balance everything we know. We'll do one more point called MIRR. We'll do one more point called MIRR. It is a small method. So we'll do what is MIRR means you are reinvesting the method. Let us see. We'll do its point. Very easy method. We have here 1, 2, 3. How many years? 4, 5. See, generally, MIRR and all, 4 years mostly will come. If at all coming. 5 years, again, little more step. 4 years, very easy. We'll do 5 years. What is the cash flow? What is the cash flow? 10,000, 10,692, 12,769. Next time, 13,462, 23. Correct? Next, what you do now? See, MIRR, this method name is called modified internal return. You can also copy. I will allow you to copy. What this method telling is what? Whatever the amount you are getting every year, you are reinvesting. You are reinvesting. So you have to first understand a reinvestment period. First, you have to understand what? Reinvestment period. Your project, how many years? Your project, how many years? 5 years. If first year end, if you are getting 10,000, how many years you can reinvest? How many years you can reinvest? Very good, sir. 4 years. If second year, if you get, how many years you can reinvest? 3 years. Here you can get what? 2 years. Here you can get what? 1. Fifth year, if you get no time for what? Reinvestment. Now next you have to go for reinvestment rate. Next you have to go for what? Your intermediate level reinvestment rate is nothing but your cost of capital, which is given in this question. Your reinvestment rate is 10%. Suppose I have told you one MTP point. Here also nothing specifically mentioned. Sometimes they'll tell reinvestment rate is 12%. They will tell you different reinvestment rate. That is why I am giving a separate column called reinvestment rate. Here the reinvestment rate is same as your cost of capital. The question is silent. You have to assume that your cost of capital is your reinvestment rate. Now you are good in maths, I know, but I don't want to take any risk. I will take compound factor. I will take what? Compound factor. 10%. If you invest for 4 years, what is the compounding rate? In your calculator you can take. Now 1 rupee. After 1 year, 1.1. Again after 1 year, it will be what? 1.21. Again after 1 year it will be 1.31. Again after 1 year it will be what? 1.46. This is the value now. This is after 1 year, 2 year, 3 year, 4 year. So we need 4 year. 1 rupee will become what? So your compounding factor you have to take 1.46 forward. This you can get in your calculator very easily. 1.1 you have to put into equal to, you will keep on getting your calculator. If it is a 12%, now you will take 1.12 into equal to, you will get it. Are you clear, friends? Now here it is how many years? 3 years. Already everything I have found for you. 1.331. Here it is 1.21. So don't want to copy, just listen. After understanding, you can copy. Here, friends, after understanding, you can copy. Now you got compounding factor. I have told you what is this concept. Whatever the amount you are getting, you are reinvesting. So if you reinvest now, what is the amount you invested plus interest you will get it. So that is what is we are going to get reinvest value. What is reinvestment value? What is the amount you invested into what is the interest rate? So this is the amount you invested. This is the compound. This you can get in another method also. Take your calculator, 10,000 plus 10%, 10%, 10%, 10%. You will get in 4 years the same amount. That is a logic. For your understanding, logic I'm telling. Clear or not? Next, so this is what? Mathematically the logic. This is the point. So are you able to get it, friends? See, so whatever the amount you are getting from the project, this is your value. So what is the total value? See, you go total value at the end of the project is what? 79,000. Are you ready? If the project end date, if you take total amount, you're getting what? 79,000. Are you agree? Yes or no? Yes, you are getting 79,000. Now we are going for the last concept called a MIRR. We are going for the last rate called what? MIRR. MIRR is the rate of return. MIRR is the rate of return which convert. What is your initial investment, my dear friend? 50,000. What is your initial investment? 50,000. MIRR is the rate of return which convert your 50,000 into what? 79,000 over a period of what? 5 years. Otherwise, we can say cumulative value is equal to present value into MIRR into power of how many years, friends? 5 years. This compound value, otherwise we call reinvestment value. That is, your reinvestment value is nothing but what is your investment present value. This is, I given the format just to recall your compounding formula. So this is the value. So here, what is your reinvestment value? 71,514. Shall we make 516? Are you okay? Is equal to investment is 50,000 into 1 point, we don't know, 1 plus MIRR, we don't know the rate, 1 plus MIRR power of what? 5. How you have to do? See, the starting stage I have told you, mostly if exam they will give 4 years only. Why 4 years? If power of 4 now, 2 time root you will get the answer. Power of 4, 2 time root you will get the answer, correct or not? But here it is power of 5. How you will get it? This is how you will get it in an interesting concept. That is why this method is called MIRR. Are you ready, friends? I will repeat once again. MIRR is tell that it is the rate of interest rate which make you 50,000 investment to what? 79. At what interest rate? At what interest rate it will make your 50 to 78? That interest rate only called MIRR. It got the IRR, MIRR rate because IRR how you do? You assume any rate, accordingly you do. That is why you call it as what? IRR. So here you have to assume any rate. We don't know the rate. We'll assume any rate. So what rate we'll assume now? Your interest rate is 10. So definitely it will be above that. So we'll assume a 12%. We'll assume what? 12%. Are you agree, friends? Why I take 12? 10 is your cost of capital, so it will be above that only. So you have to take 12%. So what I will do now? Just listen. What I have to do? I'm going up to 12%. At 12%. We are assuming 50,000 into 1.12 power of 5 years. Can you tell why we are assuming? Because maths, we can't take scientific calculator in exam hall. We can't take scientific calculator in our exam hall. That is why we are assuming an IIT. So what you are getting, friends? What you are getting? What you are getting? 88,117. So you are getting above that. We assumed about 10 only. We assumed it 12%. We got above 79. We want 79 only. We don't want 88. So we'll go a lower rate. We'll go what? Lower rate. As our friend Sairam is suggesting 11, I will go for what? At 11%. 50,000 into 1.11 power of 5. What you will get? What you're getting? We'll go for 10%. Take 10%. What you're getting? 70? 70. Well, 11, what you're getting? No, 11 you try, because maybe Sairam calculation error will come. It's a no calculator, very easy. 1.1 into 50,000 equal to. What is it? 80,000 coming. 11 to 80. So go for 10. 10 what you're getting? We can take 11 also, but we'll go for 10. Perfect. What are you getting? 70? 73? Sir, I don't know, sir. Can you please help me? These are all first class. Here 0. You are having an amount of 50%. You are getting 1.1, 1.1, 1.1, 1.1. This is how you got it. Here, this I am telling for non-math students. Math students, I have given the format. In your calculator, plus 10%, plus 10%, plus 10%, plus 10%, 5 years matter. Now, if you go for here, if you see, my dear friends, if you just analyze here, see here 73 you are getting below, but 89 you are getting what? Above. So this is how. That means your rate is between 10 and 12. It is coming between 10 and 12. How to get it? That is how we are going to learn. Are you understand the point? Is there any number calculation error? For what is coming? 80,000. This is 1, 2, 3, 4, 5. We will do here. This is correct only. You are getting 80,000 5. Correct? My dear friends, we taken randomly 37. Actually, this 37, what is the heading I have given? What is the heading I have given? Cash flow. But is this a cash flow? This is not a cash flow. This is what? Cash flow before depreciation and tax. This is before cash flow before depreciation and tax. So don't want to change. That is why we are getting below 10%. Actually, it should be about 10% only. Don't worry. If this question already we did in our class, cash flow, what is the cash flow? We correct now itself. We have taken random question. So cash flow we are not taking. I taken cash flow, but what is the cash flow for this question? 10,000. 10,450, 11,800, 12,250, 16,750. 16,750. So just listen. You will get now total answer slightly will change. 73,000. You will get a number called what? 73. So just listen. I will start from the beginning now. It's 1 minute. See your MIRR, you get 10 percentage now. MIRR will be below that, not above. In this case, it will be what? Below that. So you have to assume any rate about below 10%. We'll go with below 10%, 8%. Please assume 8% first, friends. We'll go for 8 percentage. Can you please tell if it is a 8% what you will get? So the reason it is what? We haven't taken first cash flow. We are corrected now. So can you please tell me what is the number? 73,466. Almost clear. For 73,466. If you want below, we'll take for 7%. What is for 7%, friends? 70? 70,127. For 7%, you go to what? 70,127. Correct? Now, what you will do now? Your same point, you have to go. This is actually technically this is not called NPV, but that is why we call MIRR. We simply call NPV. What is a NPV now? This is your inflow. This is your outflow. Here you have positive. This is your inflow. This is your outflow. This is 493. So at 7% you are getting 2926. At 8% you are getting what? Minus 413. That is why this method is called what? MIRR. So it will be between 7 and 8. So how you will get it? Same IRR formula, but we will return as what? MIRR. Because it's a different concept. It does what interest rate that 50 become what? 73,000. So you will go for what? It is after 7%. So 7 plus. Now you have to do what? At 7% you are getting what? 2926 divided by minus will become what? Plus. What you will get? 3,003 into what you will get? What will be the answer? What will be the answer? 7 point. This is the MIRR. So already clear. So we discussed the MIRR also. Now this is we discussed additionally for zone purpose. Now if you go for this suggestion and this MTP, they have also done this. This you can able to practice. Yes, released for the answers. Clear. So with this you can able to yes you can copy, no problem. I'll allow you to copy. You can take photo also. So this is what MIRR. So cash flow, I hope we have taken already. We have. This is a very good concept. If at all they want to test you, they can test you. 4 years now, how you will take? 4 years now, directly you can take a 2-time route. You will get the answer. So please take your own time and copy, my dear friends.